So the capital weighted really is the most reported index measurement, and that's going to hold true with most indexes out there. It's where the larger companies represent a larger percentage of the index versus the smaller companies in the S&P 500. So you got 500 stocks, but you might have, let's say, Apple is weighted at 7%, and then you might have this obscure small company that just came into the S&P that maybe it only has 0.5%. So it's not equally weighted. Now, you look at that definition as opposed to the equal weighted S&P 500, and this is an alternative method, but it gives you a better understanding of how the broader market is doing. And this is where all companies are weighted the same percentage within that index. So Apple might be at 1%, and that obscure company might also be at 1%. So it equally weights every stock within the S&P 500. And it is good to note that, from a traditional diversification and asset allocation models, when you're looking at it from how the average person invests, they tend to weight companies more equally to mitigate the risk due to overexposure from individual stocks or sectors. And when you think about the capital weighted S&P 500, it is overweighted by the tech companies. And I'll show you what I mean by that. So now this chart really represents and kind of points out that the broader market just is not rallying like the tech portion of the market is. So the S&P 500 on this chart, it's year-to-date performance up to 6/15. The S&P 500, the bar on the left, is effectively showing you that it's up 13.2% year-to-date. If you took out the 7 tech titans, these are tech companies, from the S&P 500, the S&P 500 will only be up 4.8%. Well, that's a pretty big difference there. So you can see the broader market is not really participating in what looks like a bull market for the S&P capital weighted index. Now, let's look at it a different way. Year to date, 88% of the S&P 500 gains are coming from Alphabet, which is Google, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. And another fact that a lot of people don't understand is those 7 companies represent about 25% of the S&P 500 from a capital weighted standpoint. So you can see in this chart for Q1 and Q2, the S&P standard weighting is showing 14.4% up, with the S&P equal weighting only 4. And just to throw in bonds there, bonds are only up 1.4%. So there is a significant slant right now in the S&P 500 from a return standpoint.